Okay. So we're looking at we say that we will discuss something to do with managing risk, how you handle a trade as soon as you're in a trade. Trade management is key. We have discussed a lot about trade location, maybe sitting aside as soon as and waiting patiently for the trading opportunity to come to you. So that we have talked about. We have talked about how exactly we pull our trigger, or what we wait for as far as the order flow footprint chart is concerned, so that we actually pull our trigger either to buy or to sell, and as well as now once you're in the trade, then you're expected to know two variables, and many traders love to chase the take profit, but they're reluctant to actually place a stop loss. Many traders are a bit unskilled. I would say the right word is unskilled as far as stop placement is concerned. Now, the traditional analysis, which is strict technical analysis that every trader knows from outside there, is they look, any trader can draw a trend line. Any trader can use price action and draw a bunch of trend lines and horizontal and vertical diagonal trend lines, and they use this for maybe for hiding their stops, and so on and so forth. Now, in my opinion, this is entirely my opinion, what majority do is obviously wrong as far as FX is concerned, because if everybody sees the same level, most traders are going to place a stop at a level that everybody, including the dealer, knows that we have stops at that level. So let's take a look at GBP USD today. And following the inflation data from the US, we had the pound really skyrocketing, or the dollar weakening, and we are actually trading at Brexit highs, post-Brexit highs, if I may say so. And we saw the move. I've just compressed this footprint. So let's take a look at this. This is the inflation data from the US inflation. That missed expectation, and the dollar really got squashed. And we broke a hurdle right here. And anyway, the pound actually traded a high of the year. This is the high of the year. High of the year. Now, it's pretty obvious that towards Monday we were going to get a consolidation on the way down, and we know the levels that it got to, right at VPOC. Again, it's pretty much straightforward from our strike zone, and from the high of the year, it's almost obvious that many traders were distributing and accumulating shorts, and this is exactly what I'm saying. Horizontal support and resistance. This was resistance. The black line. Look at what happened there. Classic dealer stuff right there. They breached the highs. We have a 1 hour bar closing above the high, and this is going to induce so many guys to buy, as well as trigger so many stops, because we have guys that were shorting, selling this market as soon as, and we had a move during Tokyo all the way up, and we call this shaking weak holders. This is classic dealer stuff. They will shake off weak holders, the guys that are short but are scared about they do not have the right thing. The right phrase to use is, in my opinion, is they lack proper know-how on stop placement, or where to place or hide their stops. So I'm talking about the average trader here is going to look at the high of the year and go like, okay, fine, I'm going to short at these levels, this level, and then I'm going to, maybe for managing my risk, I'll place a stop 10 ticks above the previous swing. This is what every average trader is going to do. And look at that. They grab those stops, they shake off all these guys. They were short, they were on the right side, but what happened? They were weak holders. They didn't have the guts to actually, of course they will say they lost what they intended to lose, but is it really the case? I don't think so. So the data comes in and the market falls off, and the traders will go like, I think I was right. And the worst thing is when you get stopped out and you're induced to go long. This is pure mental and psychology that I'm trying to teach here. But now, back to my point. How do we place a stop as far as order flow trading is concerned? We have a concept called the naked point of control. And this is purely my opinion on how I day trade. I like to look at naked points of control that are derived from the 1 hour H4 charts, because they are less, we have less naked POCs on higher time frames. And when you see a naked point of control on a higher time frame, it has more weight, it's more weightier than a naked point of control that is from a 5-minute chart. So if you can switch over to the same chart, you can see this is the same chart, but this is now on NinjaTrader 8. Let's have a look at this. Again, now we're seeing same levels. Sorry, 1 second. Let me just increase my thickness. So the same move, inflation data comes up. We get the massive sell-off. We have the high we're talking about here. We have the shake-off right here. Stops getting hit. So, in my opinion, how would I trade? Of course, I sent a setup this morning, and we said we're buying the pound at right around this level at 30.25. We got this bounce right here. You can see this candle that played all the way up, but we got some selling right at the previous day's low. It's normal. So as soon as I was in the trade, I had to define my risk as far as where my stop loss is, and it's almost obvious for me that I need to switch over to Ninja 8 and look at the naked point of control that is next to me, and I see the level is right here. You can see it was created on Friday as the pound was rallying. Pretty much straightforward. And if you equate that to the spot FX side, you find that the stop was right at 1 spot 30, not 30, but I think it was at 1.2980 area, which was somewhere around here. Counted like 10 ticks below. And I sent the setup like, guys, let's place a stop at 29.80, and you can see how this level, rejected price so effectively. And we're hoping that we can get the retracement back into value as we edge closer to London close and maybe deeper into a rollover. So all I'm trying to say is this: the naked points of control are very effective as far as stop placement is concerned, and I solely use them for stop placement, nothing else. No trade location, no nothing. We know the rules for trade location, so the rules remain. However, for managing risk,
one question in terms of risk reward. Do you even pay attention to that ratio for yourself? Because if you look at this chart, you could be actually being risky more than you could actually be winning. And purely statistically speaking, like a 1-to-1 ratio, you better be right like over 60%, 70% of the time to actually be profitable.
Okay.
And in that case, you aimed like for around 30 pips, and the stop loss was a little bit higher than 30 pips.
Yeah, the stop was, we had a stop of about 30, 25, 30. The stop was at 80, 20. It was a 45 pip stop. Reason being, it's a volatile session. But if you look at the target was 30.70, around this level, which was pretty much making a lot of sense, because that's about 50 pips. It's more or less like 1-to-1. Yeah. So I don't know if you really looked at the stop distance and the target distance. However, like I said, we have a significant hurdle to clear right at this level, which is the previous day's low. So we were saying we were risking, the stop was tucked in right below naked point of control, and we're saying that was about 25 plus 20 is about a 45, negative 45. The target was 30.70. The entry was 1 spot 30.25. The stop was 1 spot 29.80. So as you can see, this is 45 negative. This is about 45, is it? No, 55.
No, 45.
45.
45,
Yeah,
correct.
yeah, 45. Yeah.
35.
Yeah.
So it went well.
Yeah, it went well. It was a 1-to-1 trade-off, which for me, I gave 1-to-1 because I opened up my stop. Obviously, I don't love big stops for 50 pip stops. I don't like 50 pip stops. I think this because ideally, if you go for a 50 pip stop, you really have to be very cautious because it has to be a risky market environment where the spreads are not the spreads, but where the market is highly volatile, or you're expecting some news at some point and you're trapped in a trade and stuff like that. So trade management requires that you actually do that. But we wait to see if price really goes all the way to 30.70, because can it happen within the day? Because as you know, we're day traders. We don't like to swing positions, carry positions overnight through Tokyo. Again, we know the risk surrounding that. So really, do you want to take that gamble, pay, swap, rollover? The answer is no. Here's the thing. If you look at today's view up, it cuts across this. If I go back, maybe I can show you where view up is cutting across for today. View up is just sliding through here, if I'm not wrong. And like I was telling somebody just a few hours ago, it will be criminal to remain adamant that price is going to really rally higher to the level that we were looking as a target. And you can see why the target was created there. You can see the volume profile, right? You can see what is right on this side is the volume profile. What is on this side, which is something that I want to speak about, is what we call the delta profile. Many traders are familiar with this. Many traders are not familiar with this. This is delta at price. Why is it important? Of course, we know what delta is all about. So the target is here. Does it make sense for price? Can you gamble if price touches view up? You can't afford to gamble that price is going to deviate and cross past view up as soon as London is closed and the volumes are dropping down. You know, it is pretty hard. So you have to always weigh your options based on what you see. Trading what you see is almost the first rule that I love to apply. If price reverts back to view up, the volume weighted average price, close half, exit the position because time is catching up. Swap is coming in. Rollover is fast approaching. So no need to gamble and hold trades as you sleep. Okay. So that is entirely the concept that we're looking at. You can see now, again, we may expect that they may throw this into an accumulation before reversing this tomorrow. So again, exit the trade with 0 profit or 1 pip or 2 pips or small loss, and then look to re-enter tomorrow, because I do believe that again, the market makers will just do trademark stuff just like what they do. I just have a feeling that they are going to accumulate this. then just tomorrow they're going to do something similar to this, stop hunt and then a rise. So there's no better way than buying at wholesale. So you wait for that dip. So holding the trade overnight is not something that I would recommend. So we would exit this as soon as rollover approaches, and then if we get a lucky dip, again we call it a lucky dip, then we know what's up. We know these guys are looking for stops, and then as soon as we get order flow confirmation, because we have the 6B futures, we can re-enter long at tomorrow's levels. Like we're saying tomorrow we'll have new levels of deviations and strike zones. So get the confluence, get back in there, go long. Doesn't matter what the inflation data looks like in GBP, the UK, who cares? We trade what we see based on volume. So yeah, but I'm looking at a break-even exit today, I think, to be a fair trade, scratch trade, so to speak. All right, so I think I'll make this video as short as possible because it's really going to be a bit lengthy. So yeah, look forward for part B. Speak to you soon.